This is Satya Pradhuman of Cirrus Research, and welcome to our quarterly Outlook call. Today, I'm going to go through our latest thinking on markets. A number of the comments and exhibits they'll come directly from our quarterly report titled The Dispatch. This period, the title of the report was A Barbell Approach to Walk the Inflation Recession Tightrope. And I think, when we look at the way the market has sold down year to date, we recognize how dramatic the times are. We've got such extreme changes in positions that we're, as investors, trying to frame out. And so what you've noticed in the last 3-4 weeks is how much of a whipsaw kind of market we've been dealing with. For most of this year, investors were pricing in a strong inflationary backdrop. A few changes in comments from the Fed, a few extra moves in rates, and within the last 4 or 5 weeks, we've completely reversed into a recession posture. And my point is that I think this is the way 2022 will continue to play out. These are very dramatic times. And what you've got are the risks that are facing us. Some of this is actually the unwinding of the pandemic response. In addition to that, some of the inflation concerns are driven by the pandemic response. So this moment just got a lot more complicated if you're trying to run an equity portfolio. In fact, earlier this year, as the Ukraine invasion took place, we layered a whole other level of an inflation concern. So the initial wave was basically driven by effectively the pandemic and the post-pandemic moment, supply chain issues. On top of this, though, we're now facing a world where we may have a much more longer price, a higher price for commodities. And as a result, it creates a much more difficult backdrop. So we're really, in my eyes, we're trying to balance a few things here at the same time. And so, at the end of the day, I think this is a very, very challenging moment. One of the things I'm trying to wrap my head around is this idea of, should investors be surprised? You had such a long-dated cautionary note from the Fed that they were going to tighten. And, the average person without a finance degree could look at home prices and say, yeah, you know what, if the Fed tightens, the home prices are probably going to reverse a bit. But for some reason, we couldn't associate this with stocks. And when we started to associate it with stocks, we started with the most speculative. And so one of our favorite poster child comparisons has been in the last 18 months has been one of the innovation funds that are traded out there. The ARC product is one of the charts we've used. And what's curious is that as much as the sell-off has been underway for over 18 months in some of the most speculative pieces, it's taken quite a while for this to spread up to the more favored, more visible, the sort of bellwethers of the marketplace. But the reality, though, is that you do have yourself a moment here where valuations are being forced to reverse course. You've got the potential of a very aggressive Fed that is truly concerned about the inflationary fears that we're facing. And in addition to that, you also have a profit cycle that's legitimately peaking. And so, at the end of the day, this period is indeed very difficult. Some good news in this moment when we look at how the markets have priced in speculation, though, is that when you look at the classic measures of speculation, besides, let's say, some of the innovation stocks that we just talked about, but look more broadly to NASDAQ, you look to Bitcoin, you look to SPACs, these things they've always been tied at the hips. I think when markets were rallying, we all struggled and we were trying to define why they were different. But along comes a period where liquidity starts to reverse course and you end up getting cross-asset correlations. So I do think this is some of the system that's begun to unwind, that's unwind sharply. And to some degree, this is good news when we're looking forward in terms of how to position, how to take advantage of the moment and looking for opportunities. In the opening of the report, we had a couple of quotes, and one of them relates to the damage, the performance damage we saw in the first half of this year. And as a team, we were speaking, and one of the phrase comes up when it comes to the earnings season, which is the first cut is the deepest, which is originally the Cat Stevens songs performed by a whole lot of artists, and most of us probably know it as a Sheryl Crow song. But the heart of this, and we go through it in the report, is this idea that you've had cautionary notes on the earnings environment. In our quarterly earnings reports, seasonal reports, we put out the idea that earnings reports shouldn't be too bad. This was 2-3 quarters ago. However, we would start looking more carefully at the guidance. And so clearly the market's begun to react to what they thought was coming as opposed to the reported numbers. And so in also another constructive fashion, the first cut is the deepest. I think it is clear we're going to continue to see estimates come down. However, maybe the fallout on share prices could be less dramatic as we move forward here. The market valuations are indeed coming down. And so that is very much a welcome moment. So we use the word barbell, and really we've borrowed it from the fixed income world. And in this instance, what we're trying to balance here is the struggle between this idea that you've got a profit cycle that is indeed peaking, and at the same time, we could be facing the head of the beginning of a super cycle for commodities. And so this is a very difficult tightrope to walk. And so as a result, it makes sense to us to then look more carefully at what drives these two bins and then try to bring this together smartly in a portfolio. And so on the one hand, if the profit cycle is indeed peaking, at the end of the day, we're going to look to more earnings visibility. So when we look at top line growth or earnings, we'll know that we're benefiting if we look back from the post-pandemic, hopefully post-pandemic moment. And as a result, we're looking at peak level growth, and potentially, depending on who's measuring it, maybe it's starting to roll over, maybe it's already rolling over. But at the end of the day, the market is clearly concerned with this. And the important thing, though, is it drives investment strategies, which is it tells us what we can do that's going to be more actionable. And in this instance, this is a gimme. In other words, we know this is what we can look at for the next several quarters. The US economy is a big ship to turn. The earnings cycle is rolling over and it's just beginning. And so what we think is that this idea about earnings visibility, quality, these are traits that the market is going to consistently bid in this chaotic moment. So this is something we can hold on to. In addition to this, though, if the Fed continues to tighten, which they seem to be well underway, it does seem to me that valuations are going to matter. And as a result, paying attention to the multiples in the portfolio is another way to balance off the risk. And so this period that we're in, it doesn't give us the luxury to be able to lean heavy into one quadrant of how we want to position. It is a little bit more nuanced, and I think because of how challenging these times are, I think it's an honest way to frame the moment. And so, one thing I wanted to call out for you, as you might be aware, Cirrus Research now also has a podcast, and one of the first set of podcasts we launched was with an interview with Ken Chang, who talked a lot about, he is a hedge fund manager that runs a fund in Hong Kong. He's been invested in China for many years, also a US investor for a longer time. And his take is that, what we might be seeing here, this Ukraine moment, is not just a border being taken down, but instead it is a reframing of the global understanding that, we've grown up in a world where 40 plus years of globalization won. And is it possible now that we end up starting to unwind some of that and potentially create potential parallel global economies? And so these are big questions, and I think you'd enjoy that conversation with Ken. I found it very useful. But our point, though, is that at the same time of this profit cycle peaking, you also have pricing power in the commodity sector. So that's what makes this job very difficult right now. And so, yes, we've seen oil prices come back sharply. We've seen some of the other commodities roll back over. But if you look at this over a longer period of time, they're all much higher than they were a year, 2 years ago. And as a result, we do think that this is something that we're going to be forced to frame out. It affects us not just directly in the energy sectors, but think about the commodities, the food commodities that go into food companies. And those are also fallouts that will hit the equity market. And so as we're looking at this, we're looking for confirmations of how slow are things going to get, and where can we find the best value. And so when we look at credit markets, this could be seen in two very different ways right now. We've seen credit markets back up a couple of 100 basis points this year. And so we were, if you go back a year ago or 9 months ago, we were in this 200, 300 basis point level spreads for high yields over treasuries. And what we've seen is since then, we've seen as the Fed begun to tighten, we started to see the credit and the high yield bonds sell off faster than, let's say, the treasuries. And these spreads have now opened up about a couple 100 basis points from where we started the year. And so this is challenging because it is a pointer to the business cycle and where it's going. At the same time, we've got to remember that structurally we're in the average to lower end of credit market spreads. In other words, the bond market's telling us, yes, we are concerned, but businesses will continue to get capital. And so this is something that it does make me much more cautious, because once spreads begin to widen, it's hard for us to see them reverse on a dime. And so this is something we are watching, very closely. But put it together, how do we put this to work, given this opening that I've just thrown of a challenging environment, the tightrope between recession, inflation, and the profit cycle. And so our investment portfolios that we run, these are paper-based portfolios, and we really run them to model our strategies. We run them to also deliver support to you guys, our clients. This sort of style box that we run 3 different blends in growth: aggressive growth, GARP, quality growth. On the value front, we run deep value, relative value, and quality value. To no surprise, we are certainly going to be in the quality segment of the marketplace. And I think for the most part, this balance on the growth side between GARP and quality growth is about right. Good luck in trying to parse the difference of those two at this point, but they both seem to be working well. And conversely, when we think about the value world, we've been caught off guard by the run in deep value strategies. But again, if you're going to get oil prices to spike as quickly as they did in a few short weeks, then some of the deepest cyclical commodity groups are going to work. That tends to favor the deep value model. That said, what we are witnessing is the quality value portfolios have done very well. And so we think when we look out here, if you fast forward 2 or 3 quarters, the profit cycle had rolled over, we're potentially hitting the bottom third range of where growth rates could fade to, we would probably be changing our tune. But since this has begun, I know we've had about 8-9 months of pricing this in. I don't buy that this is over just because of this other overhang called the Fed. And so I think we're very comfortable in this moment. Now, empirically, let's go through this a little bit. When we think about high quality, it is probably the most abused word in our industry, but we measure quality in just about every flavor that most people think about. So ROE, leverage, et cetera. We've got our own homegrown measures of quality. And what we can say is that our rotation high quality last spring, last summer, was about right, which was we found them to be severely discounted, and we had begun to hint that the profit cycle was going to roll over, was going to peak. And so we got very lucky as we made that rotation, and we've started to see high quality firms work. And at the same time, they've worked really well as innovation stocks have also come down. And so one of the points that we make here is that as much as the higher quality bins have outperformed nicely, until we get some sort of more visibility on the Fed action and the severity of the break in earnings, it seems to me that investors are going to continue to rotate in that fashion. In addition to that, we also published some work that talked a little bit about high quality in a more nuanced fashion, which said that, hey, not every sector is working as nicely as you want to believe. And so when we segment the marketplace by sectors, and then we look at high to low quality, what we're finding are the classic growth sectors, classic stable sectors, the quality factors are working really well. So if you stratify them, we've seen especially strong results in high tech over low tech, high quality healthcare over low quality healthcare. Conversely, though, what we've noticed, and this caught me off guard at first, but I think we can reconcile this pretty well, which is the commodity groups have worked exactly the other way. And maybe if you really step back for a second, understanding the trajectory of oil prices, grain prices, et cetera, that makes a lot of sense, right? You've got sectors or industries that have pricing power as those commodities climb. If anything, you probably don't want the safest companies. And so I think the market's properly reflecting this gap in performance where quality is doing very well in the groups that should be the place, and low quality seems to be working as the commodity groups move. So we think this is running its course and running it well. One of the points I brought up in this barbell posture, though, that helps this sort of value tilt was this idea that innovation stocks are going to continue to break. And that's been one of our critical calls really since I would argue November of 2020. And one of our favorite indicators, as I argued earlier, was this idea on looking at the most speculative pieces of the market. And sometimes the indices hide the details. And so here at Cirrus, we try to get a little closer to what's going on. And sometimes using the fundamental data held in the ETF holdings can be really, really wonderful. So what we were saying is that, hey, you've got the pandemic moment, you've got terribly easy money, you've got this search for a vaccine, and we're on Zoom, actually, as we are now. And so what you have was these innovation stocks are running to new highs. So we stepped back and we said, wait a second, it's not about performance. Where are the multiples at and what makes sense? And what we noticed and what we learned from the data was that the range at which the ARK products would sell at, the share held in the funds over time. Somewhere in the prior 4 years or so, they ranged between, let's say, a 3 and a 6 times EV to sales, which is still a premium to the market, as it should be. However, the moment we went into the pandemic and the Fed began acting, we started to see the markets really drill down on a few key themes. And we noticed how this ARC product, the multiples went from 4 to 5 to 6 to 8. It peaked out maybe about 3-4 months after our cautionary note on this, by January 21 at about 15 times EV to sales. One thing that's constructive is this idea that it has reversed sharply. It's now back down to 4 times EV to sales. So I'm less nervous about equity valuations. That said, this idea of growth versus value could be a misnomer right now. But what we've got right here is a bifurcation of growth. That you've got what I would call are the sacred cows. So if you could use the extended FANG group as a basket, you'll notice that those stocks have not broken down as hard. And so to some degree, this is the sort of stuff that's really been driving the market much more aggressively lower. And on the surface, maybe we haven't noticed it as much because these aren't the most sizable companies that have really broken down, at least the first wave. And so this really gets back to that idea of you probably will sell the things you're least comfortable with first. And the stuff that we really like, the stories we love, those are the things we're going to hang on to dearly. And so we've used the word contagion for several months now to argue that, hey, if valuations are going to matter and it's not just a blip on the radar and we're not going to be rescued by the Fed, then this pullback in valuations is going to be systemic. And so to some degree, the phrasing we've used here is, small caps, the canary in the coal mine. Now I'll get back to the size premium in a second. But the idea here is that small growth stocks have really taken a punishing. And as a result, we think this gap between the large mega cap growth names and the rest of the market will continue to converge. And so that is I think the market risk that we're all facing, this uncertainty about growth, the uncertainty about the aggressiveness of the Fed. And as a result, we're going to bid safety and earnings visibility. And so when we look at this, we look across to other indicators that sort of back up what we're thinking. One important model that we run that seems to support this sort of growth bias, and again, the growth outlook is a lot more nuanced here because of this division that I've just flagged between innovation and quality. But the heart of it is that the outlook, our Cirrus style oscillator, that is clearly in the last 4 or 5 months has begun to meaningfully, actually more like 8 months, meaningfully move towards a growth bias. And to some degree, this feels about right. After all, if the profit cycle is going to roll over, then by definition, growth stocks will probably do better. In addition to that, when we look at the small-large debate, small caps are historically cheap. But if the profit cycle is going to roll over, the large cap asset class has a bias. So we think this is probably overstated, that this large to small trade is probably overstated. It's going to be less interesting going forward because of everything we've spoken about, of how the market's done a great job selling down riskier assets. And now, as this rate risk extends, it begins to spread upwards. So we think that, but this stuff that we're looking at between the style oscillator and the growth versus value oscillator, they're all consistent with this. When we step back and we look a little bit at sentiment, because this sort of rounds out the picture a little bit as well. If we think back about, the fall of 2020, that was a period where our risk measures had really run wild. We run a risk appetite model that is based on underlying fundamentals that relate to the risk taking within various stock groups. So if you look at earnings visibility, our high earnings visibility beating low earnings visibility, our low caps beating high caps, and so on. These are the things that add up to our speculative measure. And those measures had climbed through the scales back in the fall of 20, and they have since tumbled sharply. So to some degree, I feel as if that we've really come a long ways in terms of the speculative fervor that we're witnessing. In addition to that, the crowding concerns that we had flagged in the fall of 2020. Our measure of crowding is a little bit different. This is looking at a more fundamental view, which is to take the multiples of leadership stocks and then look at how they're trading at what premium. And those numbers had crossed over some crazy levels back in the fall of 2020, to no surprise. Fast forward a year and a half, and we are now looking at the leadership stocks sell at a discount. So to some degree, that is definitely more of it's clearly telling us that we're not stuck on 4 or 5 names anymore. But it is clearly telling us that, the concerns we had in fall of 2020 we're far from that moment. And that's, also a good thing. To sort of look forward now, sort of walk through a narrative of how we're framing the world, why we're framing it, and how to position. What are we looking at? What can we look at to sort of understand the severity of the moment? And one of the areas that we've really tied into this piece, and I think we spent a little bit more time on it in the quarterly report, is this idea about earnings expectations. Because we talked earlier about how we know the profit cycle is peaking. We also can show that earnings expectations across the cap spectrum, whether it's small or large, they're telling us the same thing. The sell side analysts have begun to cut, and they've been cutting for about 6-9 months. They're no longer as frothy as they were. The cuts came earlier for small caps, but generally the curves are very similar. But here's the rub. The problem is these estimates that have begun to get cut, if you're going into a recession, these numbers should be quite a bit lower. And so this is something to look at. I do think, though, that we've seen a lot of the price damage because of the initial wave of cuts and the initial guidance down. So the next wave of cuts, if we're right, we should see less pricing volatility, but markets aren't running to new highs because of the fundamentals right now, right? So in other words, if expectations are coming down, it's hard to see total share prices climb. And so our struggle in this moment is to watch the forward estimates, focus on earnings visibility, offset or limit the downside risk. And that potentially brings us through into the back end of this year. And so it really is going to be about earnings. One of the points, I'd flagged earlier was about the innovation stocks and small caps. A lot of folks are talking about how cheap small caps are. I mean, I think I have to step back because I absolutely love the space as a researcher, as an investor. I would love to play in less inefficient markets, right? And as a result, it's always brought me towards smaller, mid-sized companies. But here's the thing. Everyone's busy, I think. If you're a bull on small caps, I'm going to show you a relative valuation chart, right? I can give you 30, 40 years of relative values. And those numbers are going to confirm that, hey, did you know that, small caps are cheap? And we've got tons of data on it, and it feels about right. I think the numbers are good. The funny thing though is we don't get a lot of people talking about the absolute multiples. And so when we look at US, for that matter, across key regions, US, Europe, these are markets that are still tracking at secularly high valuations. And so when I look at small caps, even though they're at a discount to large and they have corrected more sharply, they are still trading in their upper ranges going back for decades. And you got to step back and understand, how can multiples trade in different ranges? There's one massive factor in that, and that's called interest rates. So if you're in a world of structurally low rates, valuations are legitimately going to climb higher. The question is, if these rates begin to reverse course, where's the ground level? And so I don't think valuations are going to be your indicator of the bottom. I do think earnings expectations are going to be terribly important. One additional element that I did flag was this idea behind the credit markets. That is something that we're watching very closely. We are a prisoner of that, but you have to watch how low quality firms are getting access to capital. If we think about this capital access, risk capital broadly, we know that the cost of growth money has climbed severely as multiples have come down sharply. In fact, you can probably amplify this if you go into the private equity venture capital world, right? So their only exit is through the public markets. If multiples are collapsing, guess what? Equity funding, the cost of funding goes up sharply to the point where you're not going to see a whole lot of activity. So that is a legitimate risk that we're going to live with for a while. That is not an overnight dead cat bounce behavior thing. And so I do think that these are the things that we are going to have to look at. One interesting space that I think we should bear in mind, though, is the small cap growth trade. I would watch this space. I do think that you've got this pullback from speculation, and it's been historic, and maybe in some ways deserved. But this risk between small growth and large growth, I think, is probably one of the neatest risk trades that are out there right now. The premium is huge. And if we're right about our outlook, it does seem to me that rate risk will drive the day. And if we're wrong about inflation becoming even a bigger issue, then this curve becomes even more compelling. That said, the reality, though, and I come back to this, the absolute multiples matter, and the bellwethers represent the market. And so even if we're right on some of these huge discounts, we're still tight at the hips. And so that brings us back to this earnings driven market, a low average return market as best as we can frame it. And so I do think, though, that this is a challenging period. You probably don't want to over position on one extreme view over another. You've got two conflicting elements going on here. So what are some of the undercurrents that we're observing given this framing, the outlook, et cetera? We love the phrase connecting the dots. We just feel that a good research shop should be connecting the dots for their clients. And I think there's the obvious break among innovation shares and the commodities rally. But what's going on is they're cloaking the fundamental rotation that's underway. Quietly, what we're observing is that fundamentals are starting to matter. We've got quantitative models, our active blends I described. In the last 12, 18 months, they're almost all of them outperforming their respective benchmarks. That just never happens. Usually it's one quadrant or the other, or some piece, a flavor or two. Notice our short models that we run. The hedge fund short books are working. And what's even more curious is that, guess what? value managers are outperforming even as we face the rollover of a profit cycle. So what gives? And so the moral of the story here is that if we are facing a world of rate risk and slowing profits, then this idea that fundamentals, valuations matter. If you're in an earnings driven market, managers have to earn their way through. And so you no longer have this friendly hand instead of an invisible hand, the friendly hand that's going to serve up for you multiple expansion, right? So I think that is very, very different, and that's quietly potentially a silver lining. And one of the other points that we talked about is that these quant models, value investing hedge funds, they will probably continue to be favored in the earnings driven environment until we get to some flush out of earnings expectations. We get to a real sort of a precipice where things are going to reverse. This may actually be here for a while. And then a couple of other points was that, ETF investors, look out. Sometimes you get what you pay for. Without a central bank flooding the system with cash, fundamentals, if they matter, active managers are going to eke out gains. And so, I think this is uncommon in a few decades where, the easy money posture has been really front and center. So that sort of summarizes some of my key observations. I think just a few housekeeping notes in terms of where Cirrus is and what we've been doing to, let's say, help you guys get the most out of the work. We've really invested in the last year, about 18 months really, on offering up the research in different ways. And so what some of you have begun to notice is you're seeing some video summaries from the team. You're seeing some tutorials from the team that are video driven. We now have a podcast channel. As I referenced that initial pair of the couple episodes that I flagged regarding global growth and inflation. And so the message is, hey, we are working to get this work to you in a more efficient way, in more flavors that you feel comfortable that you can use. And so we would love feedback. Clearly, the stuff takes effort and money. And as always, we're open. But to sort of tie this world together, a couple of things to bear in mind. There's a lot of data shuffling around right now, right? At the same time, know your bias. If it's as conflicted as I've described it, you probably have a bias in your view. Also know your source. Does your source have a bias, right? You've got a smart portfolio manager that you're watching on CNBC and they're saying X. But the question is, are they talking their book, right? So if I'm a growth manager, I may want to read the data because in all fairness, the data is really mixed, but I may read it a little bit more towards a slowdown and a recession type of backdrop. Why? Because I get relief on my rate risk concerns, right? Higher multiples won't get as punished if rates are rallying. Case in point, the last 4 weeks. Conversely, if I've got a value-driven style, if that is my nature, I'm going to look around and every data point is going to tell me inflation. Not that I want inflation as an individual, but I also know that in an inflationary environment, it generates rate risk, it punishes high multiples, and guess what? Fundamentals are going to matter. So if I'm running valuation-driven discipline, I probably get a breather. So, know your bias, know your source. I'm sure this is stuff that's covered in the TFA. But as we get more clarity, though, in this period, I think we are going to begin to tilt the scale in a more extreme direction. But for now, I think we want to amplify the robust drivers that are more visible. And so to some degree, that is a high quality bias, and that is an eye on valuations. And so I'm going to pause here. And, like I said, as a lot of these comments were driven from our quarterly, feel free to reach out for a copy of the report if you haven't gotten it. and we can happily, walk through. The report also contains a number of key investment themes we find super important at this time. I won't go through that in the interest of time, but some of the focus in our research has been done on infrastructure. We think that, infrastructure spending has been strong. It might actually get an additional boost if energy security is the buzz. We think the fallout from higher oil prices, maybe that is good for the energy sector, but it's probably bad for food and grocers as some of these other commodities are also climbing. And then ultimately, the complexity of the world, this idea that if we are beginning to separate a little bit, if the world is a little less efficient in terms of going to the lowest cost producer, then the big box stores, what we just faced in the past quarter, may be a warm up for what's coming. After all, they really need easy, cheap flow of a lot of goods, and they also need very low, very cheap, low cost, low skilled wages. All of those things have sort of reversed. So margin pressures for those types of firms could end up being around for a lot longer. And with that, let me pause here, and I want to thank you for joining us on the call today. And again, feel free to reach out to us with any questions you may have, either the emails or phones. Thank you.